Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. So quick question for you. Have you ever looked at today's housing prices and wondered, how on earth will my kids ever be able to afford a home? So it's a concern I hear a lot from parents today, and honestly, the numbers are eye-opening. According to the National Association of Realtors, the median home price in the U.S. is $435,300 right now. That's a record high. If you're on parts of the East Coast or West Coast or different areas, that number is even higher. And what it makes it even more striking is that the home sales are actually declining, but prices are still elevated. And the reason is we're dealing with low supply, high demand, wealthier buyers. And what's happening is all that is pushing first-time home buyers out of the market. It's not just first-time home buyers. It's actually someone who's trying to purchase maybe a second home or trying to start a family and move out of that condo or that small starter home into a bigger home. So what's happening is it's creating a divide between those who actually own the homes and are sitting on the equity, those who are trying to buy for the first time. It doesn't help that interest rates have increased over the past couple of years, making the monthly payment on a mortgage more expensive. Now, usually when that happens, home prices adjust downward so that your monthly cash flow or the monthly spend on the mortgage or your monthly expense is the same. But that hasn't happened. Prices have remained pretty high or consistently high across the board, or even risen in some places. So what I'm seeing a lot, and the questions I get a lot is, all right, from parents is, how can I help, or I'm thinking about helping my child or children buy a home. And because of that, I created an episode, or today's episode is going to cover how you can help, or what are your options to help your child purchase a home. So helping isn't just a generous act. It can actually be a way to strengthen your family financially, build a legacy, pass on some important values. But there's certain things you need to consider is that, you don't want to put your own financial security at risk. You want to make sure you can do it in a way that is tax efficient. It's similar to the conversation I have with people when they're trying to juggle two goals. Like, for example, okay, you're planning to save for retirement, but you also want to pay for your child to go to school, which self-promotion, I have an episode on that. It's episode number 164 of the Agent of Wealth. And today we're going to look at 4 common strategies that parents can use to help their child buy a home. So we'll talk about some of the conversations, planning steps that should happen along the way. But before we dive into this, I just want to stress everyone's family's situation is different or unique. And then what works for one person or one family may not work for another. So think of the episode, or think of what we're going to talk about as a starting point, a framework that you can use to start exploring what is the right option or what option might work for you. All right, so the first one we're going to talk about is gifting the down payment. Now, this is probably the most common ways that I see parents want to or actually help their kids. So the down payment gift can make a big difference. It can boost your child's buying power, help them avoid private mortgage insurance, and even lower the overall cost of the loan if it's a smaller loan, because the down payment is bigger. The monthly cost of the loan will be smaller. But as with most financial strategies, there's some rules that you want to be aware of and follow, mainly under the gift tax rules. So under the current gift tax rule in 2025, you and your spouse can each give up to $19,000 per child, or actually per person, which is a combined $38,000. And that you can do that without tapping into your lifetime estate and gift tax exemption. So I'll explain a little more about that. If you do want to give more, you can, but it counts against your lifetime exemption. And there's a little bit of confusion around the gift tax and lifetime exemption. So let me explain it here. The $19,000 or the $38,000 that I just mentioned, it's an annual gift exclusion. So what that means is you can, the two people, husband and wife or mom and dad, they can gift that amount to the $19,000 to any one person, and there's no form that's filed on your tax return. There's no taxes that are owed. Now, you can still give over that amount. So let's say you say, okay, I want to gift my child $200,000 to help with their down payment. Where the confusion is, people think that there's tax that's owed on that $200,000, and you don't actually have to pay tax on that $200,000. What happens is, of the $200,000, 38 of that will be considered the annual exclusion, and $162,000 will be considered a gift that eats into your lifetime exemption. So the lifetime exemption for an individual is currently $13.99 million in 2025. So what that means is, if we subtract the $162,000 from the $13.99 million, you can still give $13,828,000 over your lifetime, and no tax would be owed. If you do gift over the $38,000, a form will have to be filed in your return, and that's how it's tracked over your lifetime. If when you pass away, your estate all your value of all your assets are tallied up. If your estate does not go over $13,828,000 in this scenario, no tax is owed. So that's where the confusion is. That people think, okay, if I gift over the exclusion amount, the annual exclusion amount, I have to someone's got to pay tax on that amount, and not necessarily. It just depends. It just eats into that lifetime exemption. That when you do pass, whatever that lifetime exemption is, your assets will be subtracted from that. If it's over the amount, that's where the estate tax comes into play. Now, the one caveat here is, we're discussing the lifetime exemption of $13.99 million. It's a tax law, and those rules can change. They can be complex. They change over time. So before you make any serious gifting decisions, especially if you're going to go over that annual gift tax exclusion of $19,000, you probably should talk to someone who's qualified tax professional, financial advisor on it. All right, so back to what happens when a gift is given. So mortgage lenders are probably going to require a gift letter, which states that the money is truly a gift and doesn't need to be repaid. They want to cover themselves, or they want to make sure that, it really was a loan, which we'll talk about next. And now the money that's going to pay the child's income, it's got competing things. It's got the loan from the lender as well as the loan from you. So they want to make sure it truly was a gift. Now, as far as the financial planning aspect of this, you obviously want to make sure you're not jeopardizing your own retirement security. So before you give away a big chunk of money, you want to be certain that you still have enough, what you need to fund your future expenses, and you don't run out of money, whether it's healthcare, retirement income, or anything else that you're trying to do with your money. So on the planning side, the way we approach this is we run a retirement projection without the gift given. We see what retirement looks like. Will the person run out of money? And then what we do is we run a scenario where we take the gift out of their plan, the gift amount out of their plan, and then now what does the retirement projection look like? And in some cases, obviously it depends, but sometimes it has no impact in terms of whether they'll run out of money in retirement or not. Sometimes it does have a small impact, and maybe some tweaks can be made to the gift or to retirement. And then in some instances, it has a big impact. And then the person has to obviously decide or prioritize what's more important, the gift to the kids or their retirement. Now, retirement probably wins out, but I've seen parents be very selfless when it comes to their kids and want to do everything they can do to help their kids out. All right, option 2 is making an intra-family loan. This is where you become the lender instead of a bank. You can set the interest rate, the repayment terms that are more favorable to your child while still making sure that everything is structured correctly. And what I mean by that is the IRS actually has rules for intra-family loans. You can't just hand over money and call it a loan. The loan has to charge at least what's called the applicable federal rate. And it also should be documented in writing with the payment schedule. So for September 2025, and this updates monthly, the applicable federal rates for intra-family loans are, if the loan is a short term, 3 years or less, it has to be at least 4%. If it's a midterm, which is 3 to 9 years, it has to be 4.04%. And if it's a long-term loan, which is over 9 years, it has to be 4.83%. So if your rate isn't as high as these three that we just looked at, the AFR rates, the IRS could consider it a gift, and then you're subject to the rules that we just discussed under gifting, where you have the 38 or the 19 or 38, depending upon whether it's multiple people given that gift. If not, you're eating into your lifetime exemption amount. So if the loan is set up and it's properly recorded, it's set up as a mortgage, your child probably can deduct the interest just like they would with a bank loan. But on your end, you're going to have to report the interest as taxable income. So some people look at it and they say, okay, earning, to make that decision whether to do this or not, they look and they say, okay, I have money in the bank that's in a CD or a money market or savings, and it's earning this much. I can lend it to my child. They would probably pay a little bit less than if they used a regular lender, and I can still get the same amount or close to that amount in interest in return. So it's kind of, there's no change to the parent as the lender, and the loan may be in favorable terms to what the child could get from an actual mortgage lender. So again, people like about it keeps the wealth within the family. You give your child some financial discipline. They're making the payments. They're held accountable. But today's high mortgage rates don't really squeeze them or limit them from being able to purchase a home. All right, option 3 is co-signing the mortgage. So this is when you and your child co-sign the mortgage. It can be appealing if your child, or it could be an option if your child has steady income, but maybe not enough credit history or not the debt to income ratio that the bank or the lender wants to see. So by co-signing, what you're doing is you're lending your financial strength to help them qualify for a loan. However, co-signing comes with some risk. When you co-sign, you're just as responsible for the loan as your child is. If they miss payments, it affects your credit, and it's not necessarily like you're on the hook for half of the loan, they're on the hook for half of the loan. It's the lender will and can come after either party for the entire amount of the loan. So if payments are missed, it affects your credit. It increases your debt to income ratio, which could impact your ability to borrow if you have that need in the future. You do also want to consider estate planning. So if something happens to you, the fact that you're tied to the loan can complicate your estate a little bit. So co-signing something you don't want to take lightly, but it can be the right move in some certain circumstances. But you have to obviously be comfortable stepping in to make payments if your child can't do so. All right, option 4, probably the least common, but it is still an option, and that's buying the home yourself and then renting it to your child. And then what you can do over time is you can kind of, gift a piece of the house each year to your child to still stay under that gift tax exclusion. But in this case, what you do is you buy the house, you hold the deed, your child pays rent, either at market value or maybe slightly reduced. Again, you don't want to run into, the rent or non-rent that you charge them becoming a gift. And then down the road, you can sell the home to them, gift the home to them over time, or gift it all at once. The benefit here is that you maintain ownership, which means you capture the appreciation. Child gets a place to live with the chance to buy it later when they're more financially prepared. Obviously, like all these things, there are trade-offs here. When they own the home and they're the tenant, you're in the role of the landlord, which can put a strain on the relationship if issues come over rent, repairs, responsibilities. If you go this route, it's important to have clear expectations. Treat it as you would any other landlord-tenant relationship. Put agreements in writing to avoid misunderstandings. Those are the 4 main ones. There are some alternative approaches. So one is a shared equity agreement. That's where you help with the down payment in exchange for a share of the home's future appreciation. So it's a little more complex to set up, but it could be a good middle ground if you want your contribution to be treated more like an investment. Another idea is helping with ongoing costs rather than the purchase itself. That could be contributing to monthly expenses, helping with moving costs, assisting with the maintenance. Sometimes a smaller ongoing contribution, it's more manageable than a big lump sum. One word of caution, though, and this is with all these options, is you probably wouldn't want to go into your retirement accounts like IRAs, 401ks to help with the child's home purchase. Because, you could, It just means it's another thing to consider or look at. You just want to look and see what is the tax consequence, or not just we talked about jeopardizing retirement, but there potentially would be a tax consequence if you pulled money out of your 401k, your IRA, to do it. So you want to see what the impact of that is. No matter what path you take or what are these options you do, the biggest thing to consider and the most non-negotiable is that you have to have effective communication between everyone. So money and family can be a tricky mix. Even if everyone has good intentions, the best intentions, misunderstandings can create tension. So you definitely want to talk openly about what the expectations are. Is there help? Is the help a gift or is it a loan? If there's miscommunication, they may think it's a gift. It really is a loan. What happens if a sibling doesn't think that things are fair? Or what if circumstances change for you or your child? You gift money, but you need that. And it turns out you actually do need that money. Or can the loan, if it is a loan, can it be called at certain times? So they're tough, but they're definitely necessary conversations that you need. Sometimes having a third party can help facilitate those discussions in a constructive way. So to wrap things up, helping your adult children to buy a home, it's definitely possible. It's common. I see it a lot, but it requires thoughtful planning to do so. So step one, make sure your own financial foundation is secure. Step two, look and choose go through all these different options, the pros and cons of them, choose the right one that fits your goals, your child's needs. And then step three is keep communication front and center. And then step four is if you think it could help, use professional guidance to avoid some of these costly mistakes, whether it's jeopardizing your own retirement, help with drafting up the communication, or the actual documents to make sure it is a legitimate, whether it's loan, gift, or to avoid any of these costly mistakes. At the end of the day, it's more than just money. It's about values, family, and the kind of legacy you want to leave. So if it's something you've been thinking about or have questions, I'd be happy to talk to you about your options. We can look at the different, the pros and cons for your specific situation, and then create a plan that helps your child kind of fit what they're looking to do while making sure that your own future is protected. You can book a call, bautisfinancial.com/call. Thanks for listening to today's episode of The Agent of Wealth. I'm Marc Bautis, and I'll talk to you soon.
Don't forget to follow The Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.